Let me paint you a picture. Two neighbors, same street, same age, both 65, both retiring this year. Neighbor A spent the last decade carefully building a diversified portfolio, stayed the course through market dips, and walked into retirement with a plan that could sustain him for the next 30 years. He takes 2 vacations a year, helps his grandkids with college, and sleeps like a baby every night. Neighbor B? He made a handful of decisions in the 5 years leading up to retirement that seemed completely reasonable at the time. Decisions he read about online, decisions his brother-in-law swore by, decisions that felt safe, even smart. By 74, he had burned through nearly 40% more of his portfolio than projected. By 78, he was having uncomfortable conversations with his adult children about finances. Same starting line, completely different outcomes. And here's what's terrifying. The mistakes Neighbor B made are not obscure, exotic blunders. They are the exact same mistakes that millions of people are making right now, possibly without even realizing it. These are moves that sound perfectly logical on the surface. They get shared in Facebook groups, repeated on forums, passed down at dinner tables, and yet, when you actually run the numbers, they can quietly destroy a retirement that took decades to build. I'm going to walk you through 10 things you should never, ever do with your portfolio as you approach retirement. Not just what the mistakes are, but why they're dangerous, because understanding the reasoning is what will help you actually make smarter decisions for your own situation. This is Dividend Desk. Let's get into it. Quick disclaimer before we dive in. Nothing in this video is financial advice. Everything I'm sharing here is for educational purposes only, based on research, analysis, and experience studying markets and portfolios. For advice specific to your situation, always consult a qualified financial professional. Let's start with the most emotionally driven mistake on this list, one that affects even experienced investors the moment retirement gets close enough to feel real. As retirement approaches, something shifts psychologically. The money in your portfolio stops feeling like a number on a screen and starts feeling like your future. Every market dip feels more personal. Every red day feels like a direct threat to the life you've been planning. And so the instinct kicks in. Get out. Move everything to cash, to safety, to something you can see and touch and know won't disappear overnight. It makes complete emotional sense, and it is almost always the wrong move. Here's why. When most people think about retirement, they think of it as a destination, a finish line. But retirement isn't a finish line. For most people today, it's the starting line of a phase of life that could last 25, 30, even 35 years or more. If you retire at 65, there's a very real probability that your portfolio needs to work for you until you're 90 or beyond. Cash cannot do that job. Think about what inflation does over 30 years. At just a 3% annual inflation rate, which is actually on the conservative side historically, what costs you $100 today will cost you somewhere around $240 in 30 years. If your entire portfolio is sitting in cash or low-yield savings accounts earning 1%, 2%, or even 4%, and inflation is running at 3%, you are losing purchasing power every single year. It's a slow leak, but over decades, it drains the bucket. Stocks, for all their short-term volatility, have historically been one of the most reliable tools available for outpacing inflation over long time horizons. Yes, they go down, sometimes sharply, but over rolling 20 and 30-year periods, the data overwhelmingly favors equity exposure for investors who have that kind of time ahead of them. And most retirees do. The goal as you approach retirement is not to eliminate risk, it's to manage it intelligently. Moving everything to cash doesn't eliminate risk, it simply trades one type of risk, short-term volatility, for another, long-term purchasing power erosion. And that second risk is far more dangerous for most retirees because it's invisible until it's too late. If you do want to hold some cash as part of a broader strategy, and there are very legitimate reasons to do so, make sure that cash is working as hard as possible. Compare high-yield savings rates, use money market accounts, explore short-term CDs. Every basis point matters over time. At Dividend Desk, we regularly cover strategies for optimizing every layer of your portfolio, including your cash position. Okay, so you've heard mistake number 1 and you're thinking, fine, not cash, but bonds are safe, right? Bonds are the responsible move. I'll just shift everything to bonds. Not so fast. Bonds absolutely belong in a retirement portfolio. They reduce volatility, provide predictable income, and serve as a stabilizing force when equity markets get choppy. Nobody here is anti-bond, but there's a massive difference between including bonds in your portfolio and going all in on bonds, and that distinction matters enormously. Here's the historical context that most people miss. The 40-year period from roughly 1980 to 2020 was one of the most extraordinary environments for bond investors in modern history. Interest rates declined almost continuously across that entire period, and falling rates mean rising bond prices. Investors who loaded up on bonds during that era were rewarded handsomely, and not just with income. They got capital appreciation, too. That era made bonds look almost magical, but that era is over. Going forward, bond returns are far more likely to simply reflect the yield you buy in it, with limited tailwind from rate declines. In a world where inflation can spike unexpectedly, as we saw in 2021 and 2022, a 100% bond portfolio can actually lose significant purchasing power in real terms. Long-duration bonds in particular got crushed in 2022 in a way that shocked investors who thought they were playing it safe. A retirement portfolio needs to balance three things: income, stability, and growth. Bonds help with the first two, but if you abandon equities entirely, you sacrifice the growth component, to broken tone, and growth is what allows your portfolio to sustain withdrawals over a 30-year horizon without running dry. The right bond allocation is different for everyone, and it depends on factors like your timeline, spending needs, social security income, and risk tolerance. But going 100% bonds is almost never the right answer. This is the one that surprises people most when they first hear it, and it might be the single most important concept in all of retirement planning. Let me set up a scenario for you. Take two investors. Let's call them Investor A and Investor B. Both retire at 65. Both have the same size portfolio. Both withdraw the same amount every year. And remarkably, both earn the exact same average annual return of 7% over their 30-year retirement. On paper, they should end up in the same place, right? Not even close. Investor A experiences a significant bear market in the first 3 years of retirement. Markets drop 35%, then slowly recover over the following years. Investor B experiences that same bear market, but it happens 20 years into retirement instead. Investor A, despite having the same average return, may run out of money years before Investor B. In some modeled scenarios, Investor A's portfolio can be depleted entirely, while Investor B's portfolio is still thriving. Why? Because of when the bad returns happen, not just how bad they are. Here's the mechanism. When you're retired and drawing down your portfolio, you're selling assets to fund your living expenses. When markets are down, you're selling more shares to raise the same amount of cash. Those shares are gone. They can't recover. When markets eventually bounce back, you have a smaller base to participate in that recovery. The combination of withdrawals plus a declining market in the early years of retirement creates a hole that some portfolios simply cannot climb out of. This is called sequence of returns risk, and it's the reason that average returns are almost meaningless for retirement planning purposes. What matters is the sequence, the order in which good and bad years occur. Protecting against this risk requires intentional portfolio construction. Strategies, like maintaining a cash buffer or short-term bond allocation for 1 to 3 years of expenses so you're not forced to sell equities during downturns, or building a bucket strategy where different pools of money serve different time horizons. These aren't just theoretical concepts, they can be the difference between a portfolio that lasts and one that doesn't. This one is especially common in dividend-focused investing communities, and since you're watching Dividend Desk, let's address it head-on. The dream sounds irresistible. Build a portfolio that yields 8, 9, maybe 10% per year, live entirely off the dividends, and never touch the principal. Your portfolio grows, your income flows, and you never have to worry about market timing or selling at the wrong time. The problem is that yields that high are almost always telling you something. And this holder isn't good. When a stock or fund is yielding significantly more than the market average, one of a few things is typically going on. The price has dropped sharply, which inflates the yield percentage even though the actual dividend hasn't increased and may soon be cut. The company is distributing more than it can sustainably afford, which often precedes a dividend cut. or the fund is using complex strategies to manufacture income that come with hidden costs. Covered call ETFs are a perfect example of this last category. These funds, and there are many popular ones in this space, generate high income by selling call options against their holdings. That income is real. But the trade-off is that you cap your upside during bull markets. When stocks rip higher, you don't fully participate. Over long periods, this can lead to meaningful underperformance in total return terms, which is the number that actually matters. A 9% yield that costs you 4% in foregone appreciation is actually a 5% return, and you've paid a complexity premium to get there. Instead of fixating on yield, retirees should think in terms of total return, dividends plus capital appreciation. A portfolio yielding 3.5% from high-quality dividend growers that also appreciate at 6 to 7% annually will almost always outperform a high-yield portfolio over a 20-year retirement. And with significantly less risk. At Dividend Desk, we dig into exactly this kind of analysis regularly, because yield optimization without total return context is a recipe for disappointment. There is a very seductive story that's been told over the last decade, and it goes something like this: just buy the S&P 500, hold it forever, and you'll be fine. And for the better part of 15 years, that story has been mostly true. The US stock market has been on one of its longest and strongest runs in modern history. Funds tracking the S&P 500 have outperformed the vast majority of active managers in most international markets during this stretch. It has felt at times like diversification was just a tax on returns. But here's what history actually shows us. Leadership in markets rotates, always. No single market, sector, or asset class outperforms indefinitely. There have been full decades, like the 2000s, where the S&P 500 delivered essentially zero returns, while international stocks and bonds significantly outperformed. The 1970s, the 1930s, multiple periods throughout history where the dominant asset of the prior decade lagged for an extended stretch. And there's another layer to this right now that's worth understanding. The S&P 500 today is not the diversified basket of 500 companies it once was in practical terms. A significant portion of the index is concentrated in a handful of mega-cap technology companies. Owning the market through a simple index fund means you have enormous concentration in a sector that has already had a historic run. We're already seeing early signs of rotation in 2026. International markets have been showing strength. Value is outperforming growth in several regions. The companies that led the last decade are not guaranteed to lead the next one. For retirees especially, concentration in a single asset is a risk that simply isn't necessary. Proper diversification across geographies, market caps, sectors, and even asset classes doesn't just reduce risk. It can actually improve risk-adjusted returns over long periods. Retirement has a way of turning otherwise rational investors into market timers. As the date gets closer, people start watching the market more closely. They start thinking things like, the market's been on a big run, maybe I should wait for a correction before I pull the trigger. Or the opposite, markets just dropped 15%, I can't retire into this, I'll wait until things recover. Both of those thought patterns are forms of market timing, and both are extremely risky. The problem with market timing is not that it's impossible in theory, it's that it's functionally impossible in practice, consistently, and at the scale needed to make a real difference. Markets move based on earnings, interest rates, inflation data, geopolitical events, central bank decisions, sentiment shifts, and 1,000 other variables interacting in real time. Professional traders with teams of analysts and access to data you'll never see get this wrong constantly. And the costs of being wrong are asymmetric when you're on the verge of retirement. If you delay retirement waiting for a market recovery that doesn't come for 3 more years, you've worked 3 extra years of your life for nothing. If you delay because you're afraid of a correction that never materializes, same outcome. The market doesn't owe you a convenient entry point. The solution isn't perfect timing, it's building a portfolio that doesn't require perfect timing. A well-structured retirement portfolio with appropriate diversification, a cash buffer, and a clear withdrawal strategy should be able to handle a variety of market environments at retirement, good, bad, and everything in between. As retirement approaches, something changes in how investors experience the market emotionally. A 15% drawdown when you're 40 and accumulating is uncomfortable but manageable. That same 15% drawdown when you're 63 and 2 years from retirement feels existential. The money feels different. The stakes feel different. And that feeling is real. But it's also dangerous. There's a well-documented concept in behavioral psychology called loss aversion. Research in this field has consistently shown that human beings experience the pain of losing a given amount of money roughly twice as intensely as the pleasure of gaining that same amount. This isn't a weakness, it's actually an evolutionary adaptation. For most of human history, losses were genuinely more dangerous than foregone gains. But in the context of investing, this hardwiring causes serious problems. Loss aversion near retirement leads investors to make allocation decisions based on emotion rather than evidence. It causes people to sell during downturns and lock in losses permanently. It causes people to de-risk so aggressively that they trade short-term comfort for long-term insolvency. And it causes people to make portfolio changes during periods of maximum fear, which, ironically, are often the worst times to be making changes. The antidote to loss aversion is not to pretend the emotion doesn't exist. It's to build a system and a process that accounts for it in advance. Write down your investment policy before markets get volatile. Know what you'll do in a 20% correction before it happens. Have a plan. And when fear shows up, and it will show up, you can refer to the plan rather than your gut. Inflation is the quiet threat in retirement planning. The risk that doesn't announce itself, doesn't show up as a line item in your brokerage account, and doesn't trigger any alarms. It just slowly, relentlessly, year after year, erodes the purchasing power of your money. Most people plan for retirement using today's prices. They think, I spend $5,000 a month right now, so if my portfolio can generate $5,000 a month in retirement, I'm fine. But that $5,000 in today's dollars may only buy $30,500 worth of goods in 15 years if inflation runs at even moderate levels. And healthcare, which is the single biggest variable expense for most retirees, has historically inflated at rates far above general CPI. The cost of long-term care, prescriptions, procedures, and insurance premiums can accelerate significantly in your 70s and 80s, precisely when your income needs are at their highest. This is why maintaining some exposure to growth assets, equities, is not just a nice-to-have in retirement. It's often a necessity. You need components of your portfolio that have the potential to grow faster than inflation, so that your purchasing power 20 years into retirement is at least reasonably maintained. A portfolio that's entirely in fixed income with no growth engine is a portfolio that's being slowly consumed by inflation from the moment you retire. There's a temptation, especially among engaged and informed investors, the kind of people who watch channels like Dividend Desk, to keep adding layers to their portfolio. Another ETF for a specific factor, a covered call strategy on top of a dividend strategy, some alternatives, a few thematic funds, maybe some structured products. Each individual addition feels reasonable, but step back and look at the whole picture, and it can quickly become something that nobody, including the person who built it, can fully explain or monitor. Complexity in a portfolio is not inherently bad. There are sophisticated strategies that add genuine value, but complexity without clarity is almost always a problem. If you can't explain what each holding in your portfolio does, why you own it, how it behaves in different market environments, and what role it plays in the overall strategy, that's a red flag. For retirees in particular, simplicity has enormous practical value. What happens when you're 80 and your health isn't what it used to be, or you need a family member to help manage your finances? A portfolio with 6 well-chosen funds is dramatically easier to manage and understand than one with 40 positions across a dozen different strategies. A well-constructed retirement portfolio should be diversified across asset classes, balanced between growth and income, and, critically, understandable to the person who owns it. If you find yourself with a portfolio that's grown into something complex and difficult to explain, that's not evidence of sophisticated investing. That's often evidence of accumulated decisions that were never reviewed with a clear overall strategy in mind. And finally, perhaps the most important mistake of all, and the one that's hardest to quantify, In the pursuit of optimal returns, tax efficiency, yield maximization, and risk management, it's remarkably easy to lose sight of what all of this is actually for. Your portfolio is not the goal. Your portfolio is a tool, and the goal, your goal, is a life. Specifically, the life you've spent decades working toward and imagining. For some people, that's a lake house in the mountains and slow summer mornings with fishing rods and coffee. For others, it's traveling, finally seeing the places that were always on the list. For some, it's the freedom to spend time with grandkids without ever having to look at a budget. For others, it's maintaining dignity, independence, and the ability to handle whatever comes without being a burden to anyone. None of those goals are well served by obsessing over the last 10 basis points of yield optimization while losing sleep over market volatility. The best retirement portfolio isn't the one with the highest return on paper. It's the one that gives you enough to live the life you actually want to live, with enough resilience to handle the unexpected, and enough simplicity to let you actually enjoy your retirement rather than spend it managing your finances. There is no single right portfolio for everyone. What matters is alignment between your portfolio and your timeline, your spending needs, your comfort with volatility, and your vision for the life ahead of you. So, let's bring it all together. If you're within a few years of retirement, the decisions you make with your portfolio right now are among the most consequential financial decisions of your life, and the biggest danger isn't some exotic risk you've never heard of. But familiar sounding, commonly repeated advice that turns out to be wrong, or at least wrong for your specific situation. Don't panic into cash. Don't swing to 100% bonds. Understand and prepare for sequence of returns, risk. Chase total return, not just yield. Diversify across more than one asset. Stop trying to time the market. Manage your emotional biases with a plan, not just willpower. Account for inflation in your projections. Keep your portfolio understandable. And never forget what you're actually building toward. At Dividend Desk, this is the kind of thinking we dig into every week. If this video added value to your financial thinking, make sure you're subscribed so you don't miss what's coming next. Hit the like button. It genuinely helps us reach more people who can benefit from this kind of content. And if you have a question about your portfolio, about any of the concepts we covered today, or about something specific to your retirement situation, drop it in the comments. We read them all, and many of your questions become the foundation for future videos. This is Dividend Desk. We'll see you in the next one.